What is a central bank digital currency, CBDC? Central bank digital currencies are digital tokens issued by a central bank comparable to cryptocurrencies. They are linked to the value of the fiat currency of that country. CBDCs are being developed in several nations, and some have already adopted them. Since many nations are looking into methods to move to digital currencies, it is critical to grasp what they are and what they signify to society. Understanding central bank digital currencies, CBDCs. A government-issued currency that is not backed by a tangible commodity, such as gold or silver, is fiat money. It is a type of legal money that may be used to buy and sell goods and services. Fiat money was traditionally issued in banknotes and coins. However, technological advancements have enabled governments and financial institutions to augment physical fiat money with a credit-based model that digitally records balances and transactions. Physical cash is still extensively exchanged and acknowledged. However, its use has declined significantly in several affluent nations, and this tendency has increased during the pandemic. Cryptocurrencies and blockchain technologies have heightened interest in cashless societies and digital currencies. As a result, governments and central banks throughout the world are investigating the use of government-backed digital currencies. These currencies, like fiat money, would have the complete trust and support of the government that issued them if and when they are adopted. Goals of central bank digital currencies. There are several key drivers that pushed central banks to adopt CBDCs, such as supporting the digitization of economies, modernizing the current payment systems, strengthening monetary and fiscal policy, and improving financial inclusion. CBDC's primary purpose is to provide privacy, transferability, ease, accessibility, and financial security to companies and consumers. CBDCs might also minimize the expenses of maintaining a complicated financial system, lower cross-border transaction costs, and give lower-cost choices to people who now utilize alternative money transfer methods. Digital currencies issued by central banks would also minimize the dangers associated with utilizing digital currencies in their current form. Cryptocurrencies are very volatile, with their value shifting continuously. This unpredictability might put many households in financial distress and jeopardize an economy's general stability. CBDCs would provide a reliable way of transferring digital money to homes, consumers, and companies if backed by the government and administered by a central bank. Currently, there are more than 60 central banks that are exploring CBDCs at different levels of maturity, while 14% of central banks are now moving forward with the development and pilot arrangements of CBDCs. But before we continue, go ahead and click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell you to keep promoting our videos. Also, tell us in the comment section what your thoughts are about the central bank digital currencies. Thanks. Now back to the video. Types of CBDCs. CBDCs are divided into two categories: wholesale and retail. Financial institutions, such as banks, are the primary users of wholesale CBDCs. CBDCs would enable banks to make payments in an automated manner. The central bank allows institutions to have an account wherein they can deposit funds or use it to settle interbank transfers. This will make order transactions become more trustworthy and speedier. With this, the central bank can then use monetary policy tools, such as reserve requirements or interest on reserve balance, to influence lending and set interest rates. On the other hand, consumers and companies use retail CBDCs the same way they use actual cash. People might treat them like digital cash, safe in knowing that the currency is issued and supported by the country's central bank. Moreover, retail CBDCs are said to remove intermediary risk, the risk of becoming bankrupt and losing consumers' assets of private digital currency issuers. Payment settlement systems now operate in single countries or with a single currency. Transactions might be faster, smoother, and more trustworthy if blockchain technology is used. This invention can eliminate the need for actual cash and minimize the economic rents associated with traditional financial transactions. Issues CBDCs address and create. The following are the issues that CBDCs address. 1. CBDC reduces the danger of third-party occurrences, such as bank collapses and runs. The central bank is responsible for any remaining risk in the system. 2. High cross-border transaction costs can be reduced by simplifying distribution networks and boosting government-to-government collaboration. 3. The dollar is still the most widely used currency in the world. A US CBDC might help maintain this dominance. 4. It reduces the cost of establishing a financial infrastructure within a country in order to provide financial access to the unbanked. 5. CBDCs can directly link customers and central banks, obviating the need for costly infrastructure. On the other hand, issuing a CBDC can also create problems. 1. The financial structure of the United States might shift dramatically. It is unclear how a change would affect household spending, investments, bank reserves, interest rates, financial services, or the economy. 2. The impact of switching to CBDCs on the stability of a financial system is uncertain. For example, during a financial crisis, there may not be enough central bank liquidity to allow withdrawals. 3. Central banks use monetary policy to impact inflation, interest rates, lending, and expenditure, all of which affect employment rates. Central banks must guarantee that they have the instruments necessary to impact the economy constructively. Now you may be wondering what the difference between CBDC and cryptocurrencies might be. One of the most notable distinctions is that most conventional cryptocurrencies are decentralized, with no central authority to manage or govern them. CBDCs, on the other hand, are centralized, with the issuing government keeping the authority to administer and regulate the digital currency, as well as trace the movement of cash and even block particular individuals from trading in it. CBDCs focus on planning and decision-making for central banks and have to maintain taxation. These central banks would be able to digitally create and retire money as they saw appropriate, giving them influence over the money supply, a critical monetary policy lever, and foreign exchange. However, there is no central decision-maker with cryptocurrencies. When comparing the value of CBDCs to cryptocurrencies, CBDCs may offer better security because they are backed by the government that issued them. CBDCs can be pretty anticipated to retain or track the pegged physical currency in a stable political and inflationary environment. The value of cryptocurrencies like Bitcoin is determined by the holder's faith in the Bitcoin network and its decentralized character. This trust may not last long, posing a danger to Bitcoin's long-term worth. The history of money is entering a new chapter. Countries are now searching for ways to preserve the key aspects of their traditional monetary and financial systems while assessing new digital forms of money.